Welcome, everyone, and thank you for joining me on another episode of NCS Trading for Beginners. I'm so glad you're here today, and I hope you're ready to dive into the exciting world of trading strategies and structures. Today, we're going to chat just like we always do, like a group of friends gathering to share ideas and learn something new about how money works. Whether you're completely new to the topic or already have a little background, I promise you that by the end of our conversation, trading will seem as friendly and accessible as a fun game with friends. Let's start at the very beginning. When we talk about trading, we're talking about the act of buying and selling assets. These assets can be stocks, bonds, cryptocurrencies, or even commodities like gold or oil. Think of it this way. Trading is a lot like swapping Pokémon cards with your friends. Imagine you have a collection of cards that you really love, but you're always looking to make your collection even better by trading with someone who has a card you want. In trading, you're doing something very similar, except instead of Pokémon cards, you're trading pieces of companies, parts of economies, or digital tokens. The goal is to make smart trades that will help your overall collection or portfolio grow in value over time. Now, you might be wondering, is trading just for the big leagues on Wall Street? Not at all. Trading isn't reserved only for those in expensive suits and skyscrapers. In fact, trading can be understood and enjoyed by anyone willing to learn and practice a few basic strategies. Today, I'm here to break down these strategies in simple, everyday language. We're going to look at a variety of approaches, from the fast-paced world of day trading to the more relaxed, patient world of long-term investing. The key is to find the style that fits your personality and your goals. Before we get into the details of each trading strategy, let's talk about what exactly a trading strategy is. Imagine you're playing chess with a friend. You wouldn't just move your pieces around without thinking, you would have a plan. A trading strategy is very similar. It's your plan for deciding when to buy, when to sell, and how to manage your investments overall. Just like in chess, where you might plan several moves ahead, a trading strategy helps you think about the future of your investments based on careful research, clear rules, and an understanding of the market's behavior. Whether you're analyzing a company's financial health, looking at charts, or following the latest news, your strategy is the roadmap that guides your decisions. Now that we've covered what trading is and what a strategy means, let's explore some of the most popular trading strategies out there. I'm going to share with you a detailed look at 3 common approaches: day trading, swing trading, and long-term investing. Each of these strategies has its own personality and its own pace, so let's break them down one by one. Day trading. Day trading is like a fast-paced video game where every minute counts. In day trading, traders buy and sell stocks or other assets within the same day. They aim to profit from small price movements that occur during the trading day. Imagine you're playing a game where you have to catch a few small, quick rewards before time runs out. That's day trading in a nutshell. The idea is to make many trades throughout the day, each one capturing a little bit of profit. Day trading requires a lot of focus and quick decision-making. Since the positions are opened and closed on the same day, you're not holding on to any stocks overnight. This means you need to keep a close eye on the market from the moment it opens until it closes. It can be exciting, and it often involves using technical analysis tools such as charts, indicators, and patterns to help predict short-term price movements. For example, you might look for trends in a stock's price and use that information to decide when to jump in or out. However, day trading isn't as simple as it might seem. Because you're dealing with short-term movements, there is a higher level of risk involved. Prices can change very quickly, and even a small miscalculation can lead to a loss. That's why many day traders invest in education, practice with simulators, and create detailed plans before they even make a single trade. They set specific entry and exit points and use stop-loss orders to protect themselves if the market moves against them. A stop-loss order is like an automatic safety net that sells your asset if it drops to a certain price, helping you avoid larger losses. Despite the risks, many people find day trading attractive because it allows for immediate feedback. You can see the results of your decisions by the end of the day, and that instant gratification can be both rewarding and motivating. The key with day trading is to remain calm, stick to your strategy, and not let emotions drive your decisions. It takes practice, discipline, and a willingness to learn from every trade, whether it results in a profit or a loss. For those of you who enjoy the thrill of quick decisions and the challenge of keeping up with a fast-moving market, day trading might be right up your alley. Just remember to start small, use practice accounts to build your skills, and always have a clear plan in place before jumping in. Swing trading next up is swing trading. While day trading is like a high-speed sprint, swing trading is more like a gentle ride on a seesaw at the playground. With swing trading, you hold on to your investments for a few days or even weeks. The idea is to capture the swings in price rather than the tiny moves that happen in just one day. Swing traders look for opportunities where an asset's price is expected to move significantly over a short period. They might buy when they believe a stock is about to rise and then sell once it reaches a certain high point. Think of it like waiting for the perfect moment on a seesaw. You know that the ride will have its ups and downs, and you want to get on at just the right time to enjoy the best part of the swing. This strategy can be a bit more forgiving than day trading because it doesn't require constant monitoring throughout the day. Instead, you have a little more time to make decisions and can use both technical analysis and some fundamental research to guide your choices. You might look at patterns in a stock's recent performance, news about the company, or even broader economic indicators that suggest a trend is coming. One of the advantages of swing trading is that it can offer a balance between the fast pace of day trading and the patience required for long-term investing. It provides opportunities for profit without the need to be glued to your screen all day. However, swing trading still requires careful planning and risk management. It's important to set clear targets for when to exit a trade, just as you would with day trading. This can help you lock in gains and limit losses if the market moves in an unexpected direction. Another benefit of swing trading is that it allows you to take advantage of the natural ebb and flow of the market. Prices rarely move in a straight line, and swing traders know how to ride these waves to their advantage. It's all about timing, knowing when to enter and when to step back. With experience, you begin to recognize the patterns and signals that indicate a good swing trade opportunity. For many of you who appreciate a more relaxed approach but still enjoy being active in the market, swing trading offers a great middle ground. It's a strategy that combines analysis with intuition, and it allows you to work at a pace that might be more comfortable if you're balancing trading with school, work, or other activities. Long-term investing. Now let's talk about long-term investing. If day trading is a fast video game and swing trading is a playful seesaw ride, then long-term investing is like planting a tree and watching it grow over many years. Long-term investors believe in the value of their investments over a long period. They're not worried about the daily ups and downs of the market. Instead, they focus on the big picture, whether a company or asset is likely to increase in value over time. When you invest for the long term, you're putting your money into something that you believe will do well over the years. You might invest in companies that you think have strong potential, or in funds that are designed to grow steadily over time. The idea is to buy and hold, allowing your investments to benefit from compound growth. Compound growth is like the magic of planting a seed. With time, that seed grows into a tree that not only stands tall, but also bears fruit year after year. One of the most appealing aspects of long-term investing is that it doesn't require you to constantly monitor the market. Once you've done your research and chosen your investments, you can step back and let time do its work. This approach can be especially comforting if you find the fast pace of day trading or even swing trading a bit overwhelming. Instead of reacting to every market movement, you focus on the underlying value and growth potential of your assets. Long-term investing also has the advantage of reducing stress. Because you're not trying to catch every small market swing, you're less likely to be affected by short-term volatility. Of course, this doesn't mean that long-term investing is risk-free. It's still important to research your investments carefully, understand the industries they belong to, and be prepared for periods of fluctuation. However, the general idea is that over time, good investments will grow, and your portfolio will reflect that steady progress. Another key benefit of long-term investing is that it encourages patience and discipline. It teaches you to look beyond the immediate results and to build wealth gradually. For many people, this approach is not only less stressful, but also more realistic, especially when you're just starting out in your trading journey. You can begin with small investments, learn how the market works, and gradually build a portfolio that reflects your long-term goals. If you're someone who values stability, growth, and the idea of nurturing your money over time, long-term investing might be the perfect strategy for you. It's a strategy that rewards patience, and it's a reminder that sometimes the best gains come from waiting for the right opportunities to blossom. Understanding risk management. No matter which trading strategy you choose, one thing remains absolutely essential: managing risk. In trading, risk management is like wearing a helmet when you ride your bike. Just as a helmet helps protect you in case you fall, good risk management practices help protect your money when the market doesn't go as planned. One common method of managing risk is by using stop-loss orders. A stop-loss order is a rule you set up with your trading account that tells your broker to automatically sell your investment if it falls to a certain price. Think of it as having a safety net. If the price of a stock drops suddenly, the stop-loss order kicks in to limit your loss. This way, you don't have to be watching every moment of the market, worrying about what might happen next. Another important aspect of risk management is deciding how much of your portfolio to risk on any single trade. Many seasoned traders follow a simple rule: never risk more than a small percentage of your total capital on one trade. This ensures that even if one trade doesn't go as planned, you won't lose too much overall. It's like spreading out your snacks at a party. If one snack runs out, you still have plenty of others to enjoy. Diversification is another key tool in managing risk. Instead of putting all your money into one company or asset, you spread your investments across different sectors or types of assets. Imagine you're preparing a balanced meal. You wouldn't eat only one type of food. You'd have a variety to ensure you get all the nutrients you need. In trading, diversification helps ensure that if one investment isn't performing well, others in your portfolio might be doing better, balancing out your overall performance. Risk management isn't about avoiding risk altogether. After all, taking some risk is necessary if you want to see any reward. Instead, it's about being smart with your choices and protecting yourself from the worst-case scenarios. It involves setting clear rules, planning your trades carefully, and always being aware of how much you're willing to risk. For those of you who are new to trading, start by thinking about risk management as the foundation of your trading strategy. Even if you're experimenting with day trading or swing trading, always plan for the possibility that things might not go your way. By setting up safeguards like stop-loss orders and diversifying your investments, you create a safety net that allows you to learn and grow without risking everything. Additional structures and tools in trading. Beyond the basic strategies we've discussed, there are a few more concepts and tools that can help you build a more complete trading plan. One important area is understanding the different types of orders you can place when trading. Orders are instructions you give to your broker about how and when to buy or sell an asset. Let's go over a few common ones. A market order is the simplest type of order. When you place a market order, you're telling your broker to buy or sell an asset immediately at the best available price. It's fast and straightforward, which can be very useful in a fast-moving market. However, because prices can change quickly, you might not always get the exact price you see at the moment you place your order. A limit order, on the other hand, gives you more control. With a limit order, you set the specific price at which you want to buy or sell an asset. Your broker will only execute the order if the asset reaches that price. This is like saying, I'm only going to buy this stock if it's $50 or less. Limit orders can help you avoid surprises, but they also mean that if the market never reaches your set price, your order might not be executed at all. There's also the stop order, which we touched on earlier with stop-loss orders. A stop order becomes a market order once the asset reaches a certain price, ensuring that you exit a position if the market moves against you. These orders are essential tools for managing risk, especially when you can't be in front of your computer all the time. In addition to order types, many traders use technical analysis tools to help guide their decisions. Technical analysis involves looking at charts and patterns to predict future price movements. You might notice trends, like when a stock has been rising steadily over several days, or patterns that indicate a potential reversal. While technical analysis isn't a guarantee of success, it can offer useful clues that support your overall trading strategy. Another useful concept is fundamental analysis. While technical analysis focuses on charts and numbers, fundamental analysis looks at the underlying factors that affect an asset's value. For example, if you're investing in a company, you might examine its earnings reports, management team, and market position. Understanding the fundamentals can give you confidence that you're investing in something that has strong potential over the long term. Trading psychology is another area that deserves a mention. Even with the best strategy and tools, your emotions can sometimes get the best of you. Fear and greed are two of the most common emotions that can lead to mistakes. It's important to develop a mindset that stays calm and rational, even when the market is turbulent. Remember, every trader experiences losses and setbacks. It's part of the learning process. Keeping your emotions in check will help you stick to your plan and avoid impulsive decisions. For all these tools and techniques, the best approach is to start simple. If you're just beginning, focus on one strategy and gradually incorporate more tools as you become comfortable. Experiment with different types of orders, try out some technical analysis with basic charting software, and read up on fundamental analysis to see how companies are evaluated. Over time, you'll build a toolkit that suits your personal trading style, bringing it all together. So far, we've talked about what trading is, explored 3 major trading strategies: day trading, swing trading, and long-term investing, and touched on some of the essential tools and concepts that help you trade smartly. The common thread through all of these topics is that having a clear, thoughtful strategy is the key to success in trading. It's not about making a quick buck, it's about planning your moves, managing your risks, and continually learning from your experiences. One of the most important lessons I hope you take away from today's chat is that there is no single right way to trade. Everyone's financial goals and risk tolerances are different, and what works well for one person might not work for another. Some of you might thrive on the adrenaline rush of day trading, while others might prefer the steadier pace of long-term investing, and that's perfectly okay. The beauty of trading is that you have the flexibility to experiment and find what fits best with your lifestyle and personality. The strategies we discussed today aren't mutually exclusive. You might find that a combination of approaches works best for you. For example, you could maintain a long-term investment portfolio for stability, while also setting aside a small portion of your capital for swing trading to capture shorter-term opportunities. It's also important to remember that every trader makes mistakes. No one gets it right every time, and every loss is a learning opportunity. The key is to analyze your trades, understand what worked and what didn't, and use that knowledge to refine your strategy over time. Trading is a journey, and every step, whether successful or not, helps you become a better trader. In addition to refining your strategies and tools, keep in mind that staying informed is crucial. The financial markets are always changing, and new technologies and trends are constantly emerging. Follow trusted financial news sources, read books on trading and investing, and consider joining online communities where you can learn from others who share your interests. Continuous learning is one of the most powerful investments you can make, not just for your trading success, but for your overall financial literacy. A few practical tips for starting out. Before we wrap up today, I'd like to leave you with a few practical tips to help you get started on your trading journey. Educate yourself. Spend time reading about different trading strategies and market fundamentals. There are plenty of free resources online, including videos, blogs, and podcasts like this one. Practice with simulators. If you're interested in day trading or swing trading, consider using a stock simulator first. This way, you can practice making trades without risking real money. Start small. When you decide to begin trading with real money, start with an amount that you can afford to lose. This will help you learn without the pressure of risking a large sum. Develop a plan. Create a trading plan that outlines your strategy, risk management rules, and goals. Stick to your plan even when emotions run high. Keep a trading journal. Write down your trades, the reasons behind them, and what you learned. Reviewing your journal regularly can help you identify patterns and improve your decision-making. Learn from others, talk with friends, join trading communities, and don't be afraid to ask questions. Trading can sometimes feel overwhelming, but you're not alone in this journey. Stay disciplined. The markets will test your patience and discipline. Remind yourself why you started and always stick to your risk management rules. Be patient. Trading is a skill that takes time to develop. Don't be discouraged by early setbacks. Every trader faces challenges. What matters is that you keep learning and growing. Final thoughts as we come to the end of today's episode, I want you to remember that trading is not a one-size-fits-all endeavor. It's an evolving process where you learn to balance risk and reward, develop strategies that work for you, and continuously adapt to changing market conditions. Whether you're drawn to the rapid pace of day trading, the balanced approach of swing trading, or the steady growth of long-term investing, the most important thing is to start with a clear plan and a commitment to learning. Think of trading as a journey that can teach you a lot about money, discipline, and even about yourself. Each trade is an opportunity to learn something new, to understand the market a little better, and to grow as an investor. And while the process can sometimes be challenging, it's also incredibly rewarding when you see the results of your hard work and thoughtful planning. I encourage you to take some time after this episode to reflect on what strategy might best suit your personality and goals. Do you thrive on quick decisions and rapid changes, or do you prefer a more patient approach where you let your investments grow over time? There's no wrong answer, only the answer that works best for you. Experiment, learn, and be patient with yourself as you build your skills and confidence in trading. Thank you so much for spending this time with me on NCS Trading for Beginners. I hope that our discussion today has demystified trading strategies and structures, making them more approachable and understandable. I truly believe that with the right approach, trading can be as fun and engaging as any game, and that anyone, regardless of their background, can learn to navigate the world of finance successfully. Before we sign off, here's a little challenge for you. Pick one trading strategy that resonated with you today, whether it's day trading, swing trading, or long-term investing, and do a bit more research on it. Look for real-life examples, read about other traders' experiences, and see if you can find a trading simulator to practice your new skills. The more you learn, the better prepared you'll be to make decisions that align with your financial goals. I hope you enjoyed our deep dive into the world of trading. Remember, every expert was once a beginner, and every small step you take today brings you closer to becoming a confident, knowledgeable trader. Stay curious, keep learning, and most importantly, have fun with it. Thank you again for joining me on this episode of NCS Trading for Beginners. I appreciate each and every one of you for being a part of this conversation. Until next time, keep striving, stay informed, and enjoy every moment of your journey in the world of finance. Happy trading and take care, my friends.